Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Virgin Galactic.
If you find our talks useful, please consider subscribe, like, and comment underneath. But before we jump into things today, just a quick reminder to check out the special 14-day trial link below in the description for StockOracle.
Right, and we do need to mention that it is an affiliate link. So, the channel might earn a commission if you use it, but that's at no extra cost to you.
Exactly. And just so everyone is on the same page, StockOracle is an AI-aided stock research platform. It is absolutely not financial advice. It's not a trading signal service, and it's definitely not real-time market data.
Yeah, and AI is great, but its insights and valuation estimates can sometimes be incomplete or just completely wrong. So always verify important facts yourself before making any moves.
For sure. Okay, so let's get into Virgin Galactic.
Yeah.
Ticker symbol SPCE. Because, usually when we talk about high-growth, futuristic industries on this show, we expect to see numbers that inspire, like, a sense of awe, right? Space tourism is basically the ultimate frontier for wealth building right now.
Oh, absolutely.
You picture billionaires floating in zero gravity, sleek winged spaceships, just this massive untapped market that feels ripped out of a sci-fi novel. So naturally, you expect astronomical growth.
Yeah, I mean, the financials are supposed to match that fantasy. As investors, we're kind of conditioned to look for sky-high valuations, super aggressive revenue projections, basically a growth curve that mimics a rocket launching off a pad.
Right, but then you pull the curtain back on Virgin Galactic, and the awe you feel is, well, it's entirely different. It's more like sheer terror.
Yeah, it's pretty brutal.
Right now, as we sit here looking at the data, their net profit margin is sitting at negative 19,781%. And if that wasn't terrifying enough, the gross margin is at negative 6,127%, which, let's translate that for you listening, because rattling off massive negative percentages just sounds like number soup.
It really does.
Gross margin is essentially what you lose just making and delivering the core product. So a negative 6,000% gross margin means for every single dollar they somehow manage to bring in, it costs them over $60 just to fly the ship.
And that is before they even pay the accountants or the R&D teams, or literally just keep the lights on at headquarters. When you factor all of that overhead in, that's where you get that insane net margin of negative 19,000%. They are bleeding cash at every conceivable level.
It's basically the definition of a financial heart attack on paper. Like, when you encounter a top-line metric like that, your immediate instinct is just to assume the company is in its final death spiral. You assume the market rejected the product and bankruptcy is, imminent.
You'd run for the hills, but that's exactly why we are breaking this down today, because if you just glance at the surface, it's game over. But we have a ton of financial filings, market sentiment data, and technical chart analyses to go through, and our mission is to cut through all that noise.
We really need to figure out what is actually going on under the hood here. Is this company genuinely on the brink of total collapse, or are they quietly setting the stage for, like, a massive turnaround?
Right. And to understand them right now, you have to temporarily suspend what you know about traditional quarter-to-quarter business operations.
Okay.
Because this is the story of a company deliberately starting itself today in the hopes of completely dominating the market tomorrow. When we look at their SEC filings to get the context for this severe contraction, it's not an operational failure at all.
Wait, real?
Yeah, it's not that wealthy tourists suddenly stop wanting to go to space or that the engineering is fundamentally broken. It's a planned pause. Management made this incredibly difficult, almost paradoxical decision to wind down their first-generation spacecraft, the Spaceship Two, and completely halt all commercial flights.
Which means they voluntarily shut off their own oxygen supply. I mean, they turned off their only source of revenue.
They shut off the tap completely.
That's wild.
And they did this to funnel absolutely every resource they have, every dollar of capital, every hour of engineering talent into the development of their next generation fleet, which they call the Delta class. They are targeting the 2026 to 2027 timeframe for these new ships to officially enter commercial service.
Okay, so it's like, imagine closing your only wildly popular restaurant for 3 whole years just to build a massive global franchise. You have absolutely no income coming in, but you still have to pay the rent and all the construction costs.
That is exactly what it is.
Right.
And how they pay for that construction is key here. The filings show a mixed shelf offering.
Right, the shelf offering. Let's explain that for a second. So a shelf offering is basically like a company getting pre-approved for a massive home equity line of credit, right? You don't have to borrow the money all at once and pay the interest on it today, but the credit is sitting there, on the shelf for the exact moment you need to pay the construction crews.
That is the perfect way to visualize it. A mixed shelf offering allows them to register a new issue of securities like common stock with the SEC, but they can sell it into the market incrementally over a 3-year period. It's a proactive strategy to dynamically raise capital. It secures the financial runway they need to reach that 2026 launch without hitting a sudden liquidity wall.
Look, I get the timeline. I get the financial bridge, but I have to push back here. Even with this theoretical future fleet and this, home equity line of credit, what is stopping a competitor from just eating their lunch while they are closed for renovations? Like, does their competitive moat even matter if they are a sitting duck until 2026?
That is the million-dollar question, and it brings us to what actually makes them unique. Their primary moat isn't just that they were first or the whole Richard Branson brand. The real defensible barrier to entry is their proprietary air launch technology.
Okay, explain how that works compared to the rest of the industry.
Sure, so traditional vertical rockets-like competitors launching straight up from a launch pad, those subject passengers to intense punishing G-forces.
Right, you essentially have to be in peak physical condition, or at least highly trained, to endure a vertical rocket launch without literally passing out.
Exactly. But Virgin Galactic uses a completely different architecture. They have this massive mothership airplane that carries a smaller winged spaceplane up to a very high altitude. Then the mothership drops the spaceplane, which ignites its own rocket motor to glide into suborbital space.
So it's a horizontal launch.
Yes, it's a horizontal, lower G, significantly smoother suborbital experience. And economically, that mechanism is massive. It expands their customer base from highly trained elite athletes to, well, essentially anyone with a heartbeat and a massive checkbook.
Wow, okay.
It creates incredibly high barriers to entry for suborbital tourism because it is a fundamentally different, much more comfortable human experience than riding a heavy orbital logistics rocket.
Okay, so they voluntarily shut off their revenue to build this new fleet,
Yeah.
and they have the proprietary tech to capture a much wider demographic.
Yeah.
But the stock market is, incredibly impatient. The market rarely cares about a 2026 utopia when a company is burning hundreds of millions in cash today, which perfectly explains the absolute bloodbath we are seeing on the stock chart.
The physical price action reflects maximum pessimism right now. Looking at the current trading landscape and the data, the price is hovering around $2.49. That is a massive 72% drawdown from its 52-week high of $8.90. And it's down over 22% just year to date.
A 72% drop is brutal. Imagine buying in at $8 and watching it bleed down to $2.
It has been a grinding, painful downtrend for half a year. Think about the psychology of a shareholder who has watched their position bleed out month after month. It creates immense pressure to just capitulate and sell. But here is the interesting part. Despite all that relentless selling pressure, a floor seems to be forming.
The $2.13 level.
Yes. The stock hit its 52-week low of $2.13, and instead of crashing right through it into oblivion, it held, it bounced, and is currently trying to build a base above that level.
And the momentum indicators we're looking at are backing this up, specifically regarding trading volume. We are seeing a massive volume contraction. Trading volume is currently sitting at just a 0.42 times its 3-month average.
Right.
Now, here's where it gets really interesting for you listening. Usually, low volume just means nobody cares anymore. Does this contraction mean the weak hands, like the retail investors who panicked, have been completely flushed out? Or is the broader market just bored and completely ignoring this stock now?
Well, in technical analysis, when you see a massive, prolonged price drop, followed by a sudden stabilization in price and a severe drying up of volume, it typically signals seller exhaustion.
Meaning everyone who wanted to sell already did.
Exactly. Anyone who wanted to panic sell is gone. There is quite literally no one left to push the price lower. And what makes this specific volume contraction compelling is a recent whale alert that flagged in the data for industrial stocks, which encompasses the aerospace sector.
A whale alert meaning massive institutional money-making moves, right?
Huge blocks of smart capital. When you combine this low volatility with a heavily oversold fundamental setup, meaning the stock has arguably been punished way more severely than the actual long-term business plan warrants, it creates an asymmetrical risk-reward profile for contrarian buyers.
Okay, break that down.
Basically, the downside is relatively limited because the price is already so thoroughly crushed, but the upside potential is massive. Institutional entities, these whales, might be quietly accumulating shares and positioning for a reversal right here at the absolute bottom.
So the chart is flatlining. The retail sellers have packed up and gone home, and there are whispers of massive institutional money circling the waters. But if we really want to know what's going on behind closed doors, we have to look at the human element. We need to follow the money of the people closest to the situation.
Yeah, and if we look at the quantitative sentiment scoring across the broader market news, the mood is decidedly cautious, even aggressively bearish. There is a prevailing narrative in the analyst community right now, and it can be summed up in 5 words. Everything has to go right.
Because of the cash burn.
Exactly. The market is hyper-focused on the persistent dilution risks of that shelf offering and the heavy cash burn we just discussed.
But despite that doom and gloom headline narrative, there's a data point here that absolutely blew my mind. The insider buying. Over the last 90 days, insiders at Virgin Galactic have net purchased 176,161 shares across 8 separate buy transactions.
Compared to only one single sell transaction. It is arguably the most compelling bullish signal present in the entire dataset. The insider management sentiment is practically maxed out at a score of 99.94. But we need to explain why this specific type of transaction is so bullish. This is what we call cluster buying.
Okay, yeah, explain the mechanism here, because this is crucial for you to understand if you're listening. These aren't just executives passively receiving free stock options as part of their corporate bonus package, right?
Not at all. These are multiple insiders, executives, and board members taking their own post-tax personal cash, going onto the open market, and buying shares simultaneously at these multi-year lows.
It's like watching the ship's captain aggressively buy shares in their own supposedly sinking ship. Think about the optics of that for a second. Either they know a rescue boat is right over the horizon, or they are dangerously overconfident and just, going down with the ship in style. You do not throw your own personal hard-earned wealth into a fire unless you have absolute certainty that the fire is about to forge something incredibly valuable.
And that level of insider conviction doesn't just exist in a vacuum. There are powerful sector-level tailwinds blowing in their favor right now. Aerospace and defense companies broadly are trading much higher.
Which is partly due to rising geopolitical tensions driving massive global defense spending.
Yes, and there's also a broader excitement around the upcoming Artemis II lunar mission, which is bringing risk-on capital pouring back into the entire space sector.
And speaking of defense spending, there is a speculative rumor floating around in the data that we absolutely need to touch on. It's totally unconfirmed, but there's chatter about cross-sector applications for Virgin Galactic's platform.
Yeah, the chatter suggests their unique suborbital platform could potentially be used for defense-related hypersonic testing or even rapid global logistics. We talked about their air launch mode earlier.
Right, the mothership.
Exactly. When you have a reusable winged spaceplane that can launch from a mothership literally anywhere in the world, touch the edge of space, and then land conventionally on a runway, it doesn't take much imagination to see how the Department of Defense might be highly interested in that capability.
Especially given the recent surge in aerospace defense contracts. Okay, so we have underlying sector momentum, massive insider cluster buying, and rumors of defense contracts. What is the next actual physical catalyst that investors should mark on their calendars?
The next earnings report. And it is going to be a very strange one because, as we've established, consensus expectations for revenue are basically zero.
Because the restaurant is closed for renovations. Any revenue they report is just noise.
Completely. The actual revenue numbers will not matter in the slightest. The entire focus of the market and where the stock will violently react will be on 2 things. First, the cash burn rate. The market wants to know exactly how many millions are leaving the building every single month to fund this Delta class.
And the second thing,
updates on the balance sheet following that mixed shelf offering. Have they tapped into that home equity line of credit yet? And if so, how much? Plus, any concrete milestones detailing the physical assembly progress of the first Delta-class ships will be critical. The market needs proof that they are actually cutting metal and building what they promised.
Look, we have painted a picture of a utopian 2026, where a massive fleet of Delta-class ships are launching daily, the insiders are getting rich off their bottom fishing, and maybe they're even running secret hypersonic defense missions.
It sounds amazing.
It does. But to be responsible, we have to flip the coin here. We need to look at the immediate existential threats that could completely wipe out a position before that 2026 future ever arrives. Let's walk through the bear case.
The bear case is very real, and it starts with the most immediate mathematical threat, dilution risk. We talked about that mixed shelf offering being a lifeline, and while it secures the runway, it comes at a steep, painful cost to current investors. Let's walk through the math of how this actually hurts a retail investor.
We're talking about slicing the pie.
Exactly, slicing the pie. If you own 1,000 shares of a company that only has 1,000,000 shares outstanding, you own a specific percentage of that company's future profits. If the company is forced to issue another 1,000,000 shares at these incredibly depressed prices, around $2.49 just to survive, your voting power and your claim on future earnings are instantly slashed in half.
Oh.
Your value gets crushed without the stock price even necessarily dropping on the open market. It is a necessary evil for the company's survival, but it is brutal for the existing shareholder.
So the company survives, but your portfolio takes a massive hit.
Precisely. And the second major threat is execution risk. When the analysts say everything has to go right, they are not exaggerating. The margin for error here is essentially zero.
Because they have no underlying revenue to fall back on if there is a delay.
Right. Any delays in the Delta-class manufacturing timeline, whether it's aerospace supply chain issues, engineering setbacks during testing, or regulatory hurdles from the FAA, means they are burning through their precious cash reserves for a much longer period than originally projected.
And if that happens,
If they burn through that cash before achieving positive cash flow from commercial flights, they will be forced into catastrophic, desperate dilution at even lower prices. Or worse, full-blown bankruptcy restructuring.
look, we have utopian 2026 projections on one hand and a ticking bankruptcy clock on the other. If you are looking at the raw data, how does this possibly score as anything other than a coin flip?
Well, the quantitative analysis provides a bullish score of 6 out of 10. The fundamental setup is this. It is a high beta turnaround play.
Pause for a second. What exactly do we mean by high beta in this context?
High beta simply means its price swings are going to be violently more extreme than the overall stock market. If the broader market drops 1%, a high beta stock might drop 5%. It is highly volatile. The stock price currently reflects maximum market pessimism regarding that dilution and cash burn we just outlined.
But the insiders.
Right. However, it is fundamentally backed by unprecedented insider cluster buying at multi-year lows. If management successfully navigates the capital raise and executes flawlessly on the manufacturing timeline, the stock offers massive asymmetrical upside from these $2.49 levels. But we have to be clear, it is strictly a multi-year time frame into 2026 or 2027. We are definitely not telling anyone to buy, sell, or hold here.
Yeah, and I still have to challenge that 6 out of 10 score. If the analyst consensus is literally everything has to go right, for them to simply survive as a corporate entity, isn't calling this an investment just a very polite way of calling it a lottery ticket?
Honestly, that is a very fair, highly accurate critique. It is the absolute definition of a speculative asset. A 6 out of 10 score isn't a guarantee of safety. It is a mathematical acknowledgement that the potential astronomical reward currently outweighs the risk, if you believe those insiders know something the broader market doesn't. If a person is not comfortable with the very real mathematical possibility of the stock going to absolute zero, this is not a position they should be in. But for those with a high-risk tolerance who can afford to lock capital away for 3 years and potentially lose it entirely, the math on the upside if they successfully capture the suborbital market is undeniably compelling.
So, to summarize the stakes for you listening, Virgin Galactic is currently enduring terrifying, cash-hemorrhaging financials entirely on purpose. It is a calculated high-wire gamble to transition from slow, hand-built prototypes to a high-volume, highly profitable, modular Delta-class fleet.
The executives running the company are betting massive amounts of their own post-tax money that they will succeed. But the threats of relentless shareholder dilution and a zero margin for error execution timeline are looming right over their shoulders.
It is easily one of the most polarizing setups in the market right now.
Right.
The severe divergence between what the terrifying stock chart looks like and what the insiders are aggressively doing with their own wallets is basically a textbook study in market psychology and risk tolerance.
It really is.
And as we wrap up today's discussion, I want to leave you with one final lingering thought based on those speculative defense rumors we unpacked earlier. We spent all this time analyzing Virgin Galactic as a luxury space tourism company, taking the ultra-rich on 5-minute zero-gravity joyrides to the edge of space. But if their unique horizontal air launch technology actually has viable applications for defense.
If they can launch a vehicle that travels at hypersonic speeds, deploying from a runway anywhere on the globe?
Exactly.
Yeah.
Could the ultimate value of this company be less about space tourism and more about fundamentally changing how fast we can move critical military cargo, or even people, around the globe? If they corner the market on rapid global logistics, the DNA of this company changes overnight. Think about that next time you see that negative 19,000% profit margin.
It's definitely something to chew on. And remember, if you want to dig deeper into the AI insights and valuation estimates for stocks like this, don't forget to check out the StockOracle link in the description for that 14-day trial.
Just remember to do your own research. Thanks for joining us today on Smart Wealth with Joshua. Don't forget to subscribe, and we'll see you next time.